I think the best place to start here is last week. New York Community Bank Corp came out with some earnings that had everybody talk. I mean, the its own stock fell by almost 50% at one point, and it's down again today. It took the entire regional bank index down with it, and that's down again today. But basically, what they said was, we've got these two commercial real estate loans that created a ninefold increase in charge-offs. And everybody went, whoa, 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 wait a minute, what are you talking about here? So Ken, from your perspective, I think the big question on everybody's mind, has something changed over the last, say, couple months where before now, everybody's kind of just been waiting. We know commercial real estate's going to be a problem. You and I talked about this before, but has something changed over the last couple of months that would represent maybe the start of something going on?
Yeah, it's a good question. Well, first of all, commercial real estate is a troubled asset class. There's no question. I mean, all you have to do is look at what interest rates have done. So, and the entire value, the capitalization rates or cap rates, all of that stuff is based on what people are willing to pay, and obviously what that largely has to do with what the rates are. So this has been going on for a while, Jeff. It's not for me. It's not a surprise at all. I think I'm dealing with this every day. We're on the phones almost every single day. We've got about $2 billion in assets, and we're on the horn with a lot of our lenders, and actually I'm flying to New York in 2 weeks to talk to many, many, many more. And so what's happening is the banks have already pulled back. So if I'm going to try to buy something today, let's say, we're looking at 50-55% loan to value. Now, so the banks, that's obviously what a lot of people would call a sign or a red flag, So they, just to put that in perspective, that would have been 65, 70, 75%, just a couple of years ago. So a lot of these loans are coming due. And so you've got maturity, obviously, is an issue for both debt and for equity. And don't forget, a lot of the equity that is in some of these, let's just pick on the commercial office buildings. Those buildings typically have managed equity. So if you're looking at a tall building like this and you have a capital stack, let's say, the first, let's say 50 to 60% is debt. The next percentage is various forms of equity. Well, that equity's gone because interest rates have gone up and cap rates have also gone up. So currently there's not enough value to support the debt. And that's the real problem. And what we just saw in 2023 is it all got exposed, and people have now run out of cash largely, and they're doing cash calls, and people are coming in trying to save these things, and the new investors or new investment groups are trying to figure out, do they want to be in these deals or not. Most of them they're passing on. And so what's happening is this is just a natural progression. If a bank has a loan that's due, the value of that loan is higher than the value of the property. That's the situation. And we are, in my opinion, if this is a 9-inning game, we're in inning 2 or 3.
Yeah, I think that's what most people, I don't know if that's their sense or if just lack of information, it kind of feels like it's early in the process. But I wonder how many people are just kind of, fingers crossed, hoping everything goes really well. Yeah. Because it's just, hey, if we don't hear anything bad, then it must be going okay. But what you're saying is that, we're still trying to work out where the trouble spots are. And from what you just said, I think the alarm bell that rung in my head is that even the investors who do have liquidity, who do have cash, are saying, we're kind of sitting on the sidelines. Let's kind of see where everything goes and wait that out. Which, I mean, if you're an investor who has cash, you don't want to buy now. You want to buy when everything goes down and come in and pick up on all the bargains. So
Right. It's a good time to look. It's a really good time to look because there's distress, and when you're not going to be able to buy it from the partnership because they're going to try to, save themselves and save the equity. So the process really needs to be just like it was in 2008 when I went through this. First the equity has to go. And that's going to make its way into the 401ks, pensions, retirement plans, insurance, all that stuff. Because
And would that require a wave of foreclosures or some kind of public signal that this is going on, or can this be worked out in private? Can it be like just a bespoke arrangement? Will we get a sense that this process is moving in that direction?
That's a great question. It's going to be done mostly privately. It's going to show up, however, in obviously people's statements, in their quarterly statements, and I don't think people really understand it. That there's nothing that can be
Nobody
fixed.
understands this at all. It's a really opaque process, which is why we're all kind of looking for help here.
It can't be fixed, and here's why. The only thing that can fix it, Jeff, is lower interest rates. That's it. Because what happens is the values, when rates got down to basically zero, it created a bubble, and people bought at that price. It's really that simple. And so the prices were significantly higher 2 years ago, and I would say that they're 20 to 30% less, maybe even 40 in some cases. And it depends on the asset class, but so if you're a long-term holder and you're cash flowing, it doesn't really even matter. It's almost like buying a home and you're still making the payment and the value went down. It's not a big deal if you don't have to sell. It really isn't. And the issue becomes if the loan or the debt matures, so mostly on the loan side. So those commercial banks that lent, and mostly these are small and regional banks that lend on this money, they are exposed significantly depending on what they've loaned into. So if they've loaned into the office building market, that's getting clobbered because of the work from home and, the vacancies. I mean, I was talking to a guy this weekend. He had an office building in San Francisco and one in Phoenix, and his rent was $1 million a year. And he wasn't even going there because his employees now all work from home. So he's just waiting for those leases to burn off. And so you're starting to see these leases burn off, and there's a lot of folks that they've changed the way they do business, and they're not going to go back into these office buildings. What that does is it lowers the occupancy, of course, and lower occupancy means lower revenue, and so now they're going to struggle paying just your normal expenses, which are taxes, insurance, utilities, and all that, in addition to the mortgage. So there's a certain break even on these buildings, and they're probably in the 50 to 70% depending. Now that would be debt plus expenses. And once you start to get your revenue below that, you're in default. And so that's
Ken,
coming.
I think that's where I think a lot of the question is, because I think you've raised this issue before, shadow vacancy, which is, as you were just saying, there's office buildings that have leases, but nobody's there, and everybody knows as soon as the lease is up, there's no way to replace it. There's no demand of space, and then the companies who have these leases, they're just going to walk away from. They're not going to re-up because they don't need them. So I get the process. Okay, so then the leases, they come up, nobody leases them. So what happens then if you're a building owner, your leases go down, your cash flow goes down, and at some point, don't you have to start working with the bank, or do you just walk away from the property and say, I'm done, I can't make this work? What is the next kind of steps here?
Yeah, the answer is yes. The very first thing that will happen is the bank will contact the owner, and they'll say, okay, because don't forget, there's certain reporting that we have to do, to our banks, and the banks know all about my financials, and they're constantly looking at our projects, and because that's what the banks are supposed to do. So banks know exactly, and so you get put on a watch list, let's say, and they're like, okay, they're watching your cash reserves go down, they're watching your occupancy go down, and also, let's don't forget, in addition to the debt problem and the occupancy problem, you've got expenses have gone up a lot. So, we're getting clobbered on insurance. We're getting clobbered on property taxes. We're getting clobbered on expenses. And most people don't care. But at the end of the day, it just adds to the problem. And so, So when rates go up, so imagine I'll just give you a great example. I have two projects under construction. Now, I started these 3 years ago. It takes a long time to build these bigger projects. Our rates at the time were somewhere in the 4 to 5% at the time. Right now, they're in the 8 to 9% because they're floating rate. And so as rates go up, the monthly cost or the annual debt cost on the exact same loan, go up a lot. And so I was playing golf with a friend of mine 2 weeks ago, and he said that on one deal that he has, his debt cost went from $250,000 a month to over $500 per month. And you just can't make that up anywhere. Your rents aren't going up that much, and you can't cut expenses that much. So the debt costs have made it so hard for people to be able to hold these kinds of assets. And so there's no solution for the banks, only lowered interest rates.
Yeah, and then, well, I think the real issue is how do we know where all of these faults, like, because we have no information, we have no public information. That's why I think the New York Community Bank Corp news was such a shock, because that was one of the first ones that said, yeah, we all know there's a problem, but let's put some numbers on it. So let me ask you that, Ken. Do you have a sense of where, you said we're in maybe the second inning here, but do you have a sense of how widespread these difficulties are? Is it just the office towers? Is it just, San Francisco and New York? Or are we seeing things in some core markets that maybe you wouldn't necessarily associate with big real estate? How widespread is this issue of really cash flow meeting that debt threshold and getting us closer to the point where business or building owners or property owners just say it's just not worth the hassle anymore? I think, as you said, the important point is in everything, liquidations, forced selling. That's where the real, forgive me, the shit hits the fan, is when everybody's forced to sell. And I think we're trying to figure out where that is. So, in your sense, how widespread is the issue?
It's widespread, but it's also, it's solvable in so many ways. So, I think if you drew a line in the sand from, let's say, if anything got bought in, let's say, the last 2 years, for sure, 2.5 to 3 years, anything, you had higher values, you had higher loans, and you had low interest rates. Okay, so if you just put everything in that category, and that could be, a lot of small regional banks. Believe it or not, some of the big boys, some of the big banks, are actually not very much exposed in a lot of these. And I think a lot of people, when they think of where the problem is, the office buildings are easy to point at, obviously, but it's everywhere. It's anything that was new construction, like what I just explained. That increase on the construction loan affects cash flow. So anything that's newly being built, that's all in some form of distress. You've got, you have a lot of regional centers, as far as like regional malls are actually dying on the vine. And so, as those stores, start to go away, I'm talking about big stores, like Kmart, Macy's, Sears, JCPenney's. Those are gone. A lot of people grew up with those. Those are gone. And so when those are gone, the smaller stores in those areas also die on the vine. Now, that's because of, call it the Amazon effect, or, whatever it might be, where, people order stuff and come straight to the door. So there's just a whole bunch of things going on at once. And I think that, it's regional largely. And it depends a lot on what the banks did on those particular asset classes.
You said that the banks are now demanding a little bit more equity to refinance. Are you finding that there are fewer banks that are even willing to take your phone calls? And they'll probably take your phone call, but let's say somebody else in your position or somebody else in the same business who's not in necessarily the same position. Are we finding fewer banks that are willing to roll over debt? Are they hanging up the phone and saying, "Call me in 2 years if you're still around"?
So it's a great question. Well, first of all, I don't think that most people have the ability to refinance. So that's a huge point. So just imagine, let's say I bought something that was $100 million 2 years ago. Well, I would have, let's say, put 70 million of debt and 30 million equity in a property like that, let's say. Okay. So now let's fast forward that exact property 2 years later. That property is probably worth 70 million. So now again, if it's cash flowing, it doesn't really matter to me, honestly. I mean, yes, I've lost 30 million in value, but it only matters if I have to sell. So if I can hold it through that period of time, and this happened to me in 08, 05, 6, 7, 8, 9, 10, I was, this is the same kind of stuff that happened. Values do go up and down. So, but let's just go back to that example. So now that property's, let's say, worth 70%, and I'm trying to buy it now. Okay, let's say that person's trying to sell it. Their equity's gone, obviously. That 30 million's gone. Now it's worth 70 million. The bank's probably going to loan maybe 55, 60% on that. So let's say they loan $50 million. It doesn't really even matter. Now that person has to come up with 20 million to buy it. So $50 million loan, 20 million equity. The real issue is the person that's selling. Now, because I'm going to, if they're lucky, I'm going to buy it for 70, which is just their debt, if they're lucky. But more than likely, a lot of people are going even lower than that. So if I think it's worth 60, then that seller now has a $10 million problem, right? The equity's gone. And so the bank has a problem and the seller has a problem. So that's the real issue is, the whole market is determined by cap rates or capitalization rates. And cap rates were down in the 3 and 4% range, and now they're in the 5s.
Hey,
So
Ken, just for people's their own understanding, could you explain the cap rates for them? Because I think that's
of course.
like you say, that's a key issue, and I think people may not have heard that term before, and even if they have, they may not get it straight.
It's a great question. Okay, so you with any commercial real estate, actually any business, you've got your income and you got your expenses. And after that, it's called net operating income, or NOI. So all banks lend on that. That's a really important piece. And so let's say there's a $1 million NOI, $2 million in revenue, $1 million in expenses. You got a $1 million NOI. Okay. So when the bank's looking at investing into a project, they're looking at that because that's actually what's going to pay back their debt is that $1 million. So all of that determines the price, of course, and as debt goes up, then, of course, the bank's going to lend less, because your cash flow's less. And so the bank's always looking at NOI. As the banks start to lend less, I'm talking about loan to value, then what happens is the price of the property goes down. And so the price of the property divided into the NOI is the capitalization rate. So the capitalization rates they vary from municipality to municipality. They're typically lower in downtown core, and they're typically a little higher in the rural areas. But the point is that cap rates have gone up, at least 20, even 30 basis points. So if a cap rate goes from 4 to 5, that's a 20% reduction in value. So because let's say if you divide 4% into the 1 million, that's one number. If you divide 4% or 5% into 1 million, that's another number. So all things being equal, the NOI stayed the same. So just the cap rates have gone up and it all has to do with the debt. And there's another rabbit hole that I'll promise not to go too far down, but that's the debt service coverage. So, typically banks, let's say there's $1 million NOI, a bank might only lend. They're solvent to their debt payment. So maybe they're solvent to $600,000, and they're saying, there's a $400,000 cushion there. We'll lend up to $6,000 or $600,000, let's say. So what they're doing is they're backing into that, because they have the rate, and then they look at the loan to value, and they're really working off that net operating income, because what's going to pay a bank back is the NOI. And so all of that's happening kind of behind the scenes. And as the interest rate goes up and as the debt cost potentially goes up, then your cash flow is going down. So you have a value that's going down and you have a cash flow going down, even though the property might be performing the same as it was, a year or two ago. Now, and then on top of that, you also have operational issues like work from home, the higher expenses, occupancies obviously have gone down in a lot of spots. So, it's not so black and white, but the bank looks at the whole picture.
There's a risk, as we just talked about with shadow vacancies, for something like an NOI shock, right? Because as you're saying, as a lot of these leases come up that companies don't need, they don't renew them, cash flows are going to go down on the margins. It may not be a huge amount. Maybe it is a huge amount. So not operating surplus goes down. At the same time, values are going down. So doesn't that mean cap rates are going to have to go way up necessarily? It's potentially a shock here.
Yeah. It's a great point. So there'll be different cap rates for different kinds of asset classes. So if for example, if there's a market where everybody wants to be in it and the occupancies are high, then your cap rates are going to be lower. But then there's going to be markets where cap rates are going to go up where nobody wants to be. We'll just pick on Portland, let's say downtown, or pick on San Francisco, or pick on Seattle, which is, where I'm from. I have friends that obviously I grew up in Seattle and I did a lot of commercial real estate in Seattle and while downtown Seattle is probably not where anybody wants to be, just in the suburbs is not so bad. It's actually a lot of people moved out of the core into these suburbs and put pressure on those markets. So a lot of it depends. It's the thing about real estate is it's not a national issue. It's very localized little business, and as we have layoffs, I know we're going to kind of touch on this labor market, but as you start to see 1,000, 2,000, 10,000 layoffs in these particular markets, or that's definitely going to affect not only office, but multifamily, single family. Obviously, you've got people that are being displaced, whether they get a new job or something else, or they move, who knows? But all of that has to do, with the performance. I always tell people, without people, real estate doesn't do very well, right? So as things, change, so do the economics of the real estate itself.
Okay, I want to go back to one thing because I interrupted you as you were going through your example, and I think this is an important one about the seller, the guy who has lost his $30 million equity, and now the potential buyers are coming in and saying, I'm only going to give you 60. So he's got a $100 million property. He's already lost 30 million in equity. Now he's getting offers that are 10 million below what his debt is. So now we've got the seller who's really motivated not to sell. We've got the bank who is really motivated not to do anything. And you've got buyers who are motivated to only buy up at the lowest possible price. And you can't blame them for that. So it kind of sounds like we're at a standstill. That does seem to describe the situation that we think that we're seeing, where nobody wants to do anything and everybody's just kind of hanging on for one thing or another to shake everything loose. So my question to you, Ken, is just from your perspective, or not from your experience, obviously not your perspective, but how long can, say, the guy who owns the property who's underwater now, how long can he hang on? How long would the bank be willing to hang on and say, I see all these metrics going the wrong way, and now the properties, the offers that we're getting to buy your property are well below the debt level. How long can all of that just kind of stay in stasis for lack of the incentives not being to sell the thing?
Yeah. Well, I think the first thing, obviously, if you don't have to do anything, you're not going to. Right.
And that's a function of cash flow, right? If you've got the cash to cover the debt, then you can everybody's just going to be like, hey, just let's not do anything.
Right. So if you have cash flow and your values are down, you're fine. Right. You're absolutely fine, because it's like selling a stock, right? Like if you sell it at a loss, it's a loss. But if you hold it long enough, it's possible that it can go back up and things change. So if you have the cash flow and the values are down, you're in fine shape.
So then the question becomes, what interrupts the cash flow? So if you're just hanging on there And then we have, like we said, where some of your leases come due and nobody replaces them. Suddenly your cash flow goes down. Now everything starts to get set in motion. So there is an economic, it does seem to be there is some kind of economic relationship there. But also, the other thing would be refinancing, right? So you're fine on a cash flow basis, but the bank is saying, you took out a 3-year bridge loan that's coming due, and suddenly the bank is like, okay, how would you think that the bank would be more willing to, let's say they have a short run maturity this year sometime, and the situation is cash flows are somewhat questionable, but they aren't yet below a certain debt level or the debt service level. Would the bank be willing to work with that property owner, even though it would be a huge risk? Or are you seeing some of these banks saying, I don't know what I want to do here, but I don't really want to refinance this thing. Huge thank you to Ken McElroy for stopping by and sharing his incredible insights into all of these important topics. There's a whole lot more to that conversation, all about commercial real estate, funding, forced selling, as well as the general economy, what's happening in the labor market from Ken's deep inside perspective. The rest of that conversation, the video, that's available to Eurodollar University members and subscribers. And if you aren't a member or subscriber already, there is a whole lot there waiting for you. Not only do we have Ken's great conversation, there are others that we've just had recently with people like Hugh Henry, Principles of the Madhouse, or Jim Rickards, the inside story to 1998's LTCM and why it matters today, Macro Elf, Mike Green, Brent Johnson, and those are just the conversations that we've had. There's also a ton of material, background information, what the Eurodollar is, why it matters, how it's supposed to work, how money is supposed to work, and what money is today. And then on top of Eurodollar University memberships, there are also these research subscriptions. What's happening now? The daily briefing that gets you updated every day, the biggest macro news as well as developments in the marketplace, and the deep dive analysis where we take those topics far deeper to really understand what is happening, why it's happening, and why it matters. And just for you, we're putting together a special unadvertised sale, bundling all of these together. Get your membership, your daily briefing subscription, as well as the deep dive analysis, all for one low price. There's a ton of information and content available for Eurodollar University members and subscribers. The conversation we just had with Ken, great conversation, great detail, great information. That's just the tip of the iceberg. So if you want to check it out, link in the description, unadvertised sale. As always, I thank you very much for joining me, and I'll see you again next time.